Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. Very good morning. Today will be Wednesday, the 24th of April, 2024. So before we start our daily dose, as usual, the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into our daily dose of market insights, that means i.e. the short-term technical outlook of the various broad-based cross asset classes, let's have a recap of what has taken shape yesterday in terms of events as in news and economic data releases, as well as the responding performance of the broad-based cross asset classes, and as well as today's event that has taken shape before the start of our daily dose, that means early Asia session. So yesterday, what we see over here is the second consecutive day of risk on behavior. It's more likely to retrace that 3 weeks of decline or 3 weeks of risk off behavior that has taken shape previously. So yesterday, the US benchmark stock indices has its second consecutive day of close to a 1% increase on the average. So yesterday, all the major US stock indices actually rallied. So what we could see over here is the SPX gained by a fair bit of 1 point. Okay, if you look at my screen over here, let me refresh my screen. So the SPX gained by 1.2%, the Nasdaq gained by 1.5%, the Dow Jones Industrial Average underperformed but with a positive gain of 0.7%, and the Russell 2000 outperformed by 1.8%. All right. So the yesterday's gain itself, and as well as the gain on the prior day, is more related to firm-based specific news flow rather than macro factors. Later I'll share with you, in fact, the macro factors are not favorable of a bullish tone on the stock market. However, market is solely focusing on the earnings releases that is actually due this week on the Magnificent Seven stocks. So why Magnificent Seven stocks? Because the Magnificent Seven stocks, the 7 of them are the highest weightage stocks, market cap stocks inside the broad-based US major stock indices, 2 of them, which is the SPX and as well as the Nasdaq 100. So if you look at the heat map of the SPX itself, what we could see is a very strong intraday positive movement at the end of yesterday in Microsoft, which is one of the biggest cap stocks that is going to be one of the Magnificent 7 market cap stock, biggest market cap stock inside the S&P 500, gaining 1.65% yesterday. Google as well, 1.25%, and Metal very, very strong, 3%. So taking in mind that Metal and Microsoft will release their earnings results this week, starting from Metal. Metal will release it today at the end of the US session. Microsoft release it on Thursday at the end of the US session, followed by Google, Alphabet also on Thursday as well. So given a very high optimism that is being priced into the market over here, that actually managed to spread the positive feedback loop throughout the technology sector and the technology sector as a whole, and as well as the communication service sector, all gaining very, very strong positive daily gains yesterday that starts to just spread throughout the entire US stock market. So what we could see over here, very interestingly over here, is that market has started to price in high optimism of this earnings results of the Metal, Google, Google with Alphabet, as well as Microsoft. Okay, and Apple and Amazon will release the result next week. So there's actually a situation right now is that since market has been priced into their positive earnings results expectation that is actually going to be released pretty soon, that means this the market right now is facing a very high bar, that any slight disappointment in this earnings result releases of Meta or Google could actually potential translate to a negative feedback loop back into the market. And given the fact that the bigger picture, which is the macro factors that are still negatively averse or not favorable for a bullish, we call it a sin for the major US stock indices, especially with the US 10-year Treasury yield that is inching much higher as we speak. That means they're still holding pretty much firm above that 4.5% medium-term resistance level. Formally, that has already been taken out last week. So I'll flash you the chart of the 10-year US Treasury yield. So one thing on the back front over here is geopolitical risk premium very likelihood it's going to be ticking up higher from here. Why? Because the US Senate has passes the Ukraine Act, and very likely Ukraine will start to receive more arms and funding from US, and that also include Israel and Taiwan as well. So given that it seems to us that US itself is now engaging in this proxy war, with the proxy war where it don't deploy direct physical forces in these areas of conflict, but supporting it through funding. And Russia has already responded pretty much strongly is to increase strikes on Ukraine over US aid. So what we're going to see over here is that since US itself has been more or less involved in this area of we call it Middle East tension and Russia and Ukraine tension, the the reaction effect from the other camp is very likely going to be tit for tat in nature. That means it will keep on spiraling of this never ending tension, unfortunately, in these two hotspots globally. So with that being said over here is that it's not going to be gel well for the global markets as well in terms of the risk asset classes. Why? Because more tick for tat regulatory tick for tat retaliation measures between the stakeholders that are involved in Russia, in Russia-Ukraine war, as well as in the Middle East tension over here, that could actually threaten oil prices to go up much higher, especially from the Middle Eastern region, with Iran getting back into the picture as well. Yesterday, oil price actually remained firm above our support level at 80.80. And do not forget over here is that later I'll share a chart. Rising oil prices also doesn't gel well for inflationary expectation in the US. So if US inflation expectation going to tick up much higher from here, the US Federal Reserve will find a hard time to actually enact its first interest rate cut. That could also increase the US 10-year Treasury yield on the upside, putting higher cost of funding coming back into the market. So that is also a negative macro factor that could actually doesn't set a kind of a longer term to medium term bullish scene for the major stock indices. So what we could see over here is that I like to repeat is that the 2 days of consecutive increase in the US major benchmark indices is more driven by macro factors. That means earnings expectation rather than an improve in macro factors, which is the bigger picture. So if the earnings expectation has more or less been died off after the next few weeks, macro factors will be in the forefront again, and that could actually put a cap on this ongoing 2 days of a rally in the US stock market. And worse still, given the fact that the markets has now rallied ahead of the earnings releases of Meta, Microsoft, and Alphabet that is going to be released today and on Thursday after the close of the US session. If Meta, Alphabet, and Microsoft do not perform as expected, what is market is being priced right now, the negative feedback loop could actually come back into the picture as well. Okay, because right now market is being priced as a high hopes. Okay, on this mega cap stocks. All right, so now with that, right, let me share with you all something on the chart. What I'm talking about is the 10-year US Treasury yield. Okay, so this is the negative macro factor that is still prevalent in the market. So the US 10-year Treasury yield, if you look at it over here, let me very quickly share with you all. Where is it? Yep. Okay, so the US 10-year Treasury, after the break of that 4.5% key medium-term resistance level, now turns into a pullback support. Prices are still holding pretty firm above this level, and if you were to look at currently, it's still also above the 200-day moving average at 4.3%. Okay, at this juncture. So net overall, the medium-term uptrend still remains pretty much intact for it, but potentially to retest the 5% level. That was the 52-week high that was made last October. And also the daily RSI, yes, it's kind of overbought at this juncture previously, and now managed to work out from that overbought region. During hitting the overbought level, it didn't flash any bearish divergence. So previously, right, at the point in time when it hit that 4.5% level last year, higher high, also the upper boundary of this long-term circular ascending channel since March 2022, the RSI went to the overbought, but it flashes out a bearish divergence. So that actually explained that multi-week decline or that multi-month decline, all right, previously. But however, this time around, there's no bearish divergence. So indicating to us that this medium-term uptrend phase could potentially extend much further. So if the US 10-year Treasury going to extend on the upside, it means higher cost of funding. Higher cost of funding will actually trim net profit margin. So that is a negative macro factor that may not gel well for the earnings potential of US stock indices going forward. Okay, another negative macro factor will be higher oil prices. Okay, so how does higher oil prices translate into a negative macro factor? Is because through future inflation that is being measured by market-based break-even rates that is derived from the Treasury inflation protection products, that we could actually see how does market is actually expecting inflation to evolve 5 year and 10 year from now. So if you look at the break-even rates over here, so break-even rates are still pretty much in a uptrend, medium-term uptrend mode since the low of December last year. So now the 5 year and the 10-year break even. So think of it as break even rates as the 5 year break even rate is at 2.44%. That means market is expecting 5 year from now inflation in US to be at 2.44%, and 10 year from now is at 2.41%. So that actually a defeat or doesn't bodes well to the Fed. Why? Because the Fed wants inflation to actually come down to 2% level. So given that it's a very strong up move or strong persistence medium-term uptrend that is still intact since the low of December, the Federal Reserve itself will find it very hard. So they are being boxed in a corner to actually unite the first interest rate cut. And also bear in mind that notice that the 5 year break even and the 10-year break even move in line with the WTI crude oil prices, which has been moving up as well since the low of December last year. And like I explained earlier, given the fact that geopolitical risk premium is more on the positive side, more ticking upwards rather than ticking downwards, given the fact that the US itself now has started to get more involved in the proxy war between Israel and Hamas, and right now between Russia and Ukraine, through more funding and more weapons supply. So there will be a much more forceful tick for tat measure by the opposite camp, and that could, especially in the Middle East region, that could also cramp down supply and unfortunately supply of oil, and unfortunately oil being used as a weapon for future diplomatic negotiation. If that scenario start to play out, higher US 5 year and 10-year break inflation rates were going to tick much higher. That means, i.e., elevated US inflationary expectation going forward. That could actually put the Fed in a tight spot to actually cut interest rates. So potentially there could be no interest rate cut for this year, potentially, and that could also see lead on to a further rise in that US 10-year Treasury yield as well, given the fact that the US 10-year Treasury yield also has a very positive direct correlation with the rises in the 10-year and the 5-year break-even inflation rate. All right, so that is a negative macro factor. All right. So with that in mind, so I hope that I share with you the interlinked picture between what has taken shape in the short term, and it doesn't the longer term the macro factors doesn't actually support these 2 days of strong movement in the US stock market. All right. So now another thing I want to share with you all over here is not only inflation has started to creep back into inflation, higher inflation has started to creep back into US in terms of inflation expectation, but inflation also has started to creep back into Australia as well. So if you look at the latest Australia, give me a minute, yeah, the latest Australia Q1 and monthly inflation data that was releases earlier today's Asia session at 9:30 a.m. Singapore time. The Australia rate, the inflation rate, that's including energy and food prices for Q1, actually rose slightly above expectation at 3.6% year on year. Market is expecting it to come in at 3.4%. All right. So if you look at the trim min is excluding food and energy. It came in at 4%, also slightly above expectation at 3.8%. And also the most recent monthly CPI indicator, so that one is on a monthly basis. On the annualized rate for the month of March, it came in also slightly higher at 3.5%, above last month 3.4%, and the consensus of 3.4%. So if you look at the trend of the monthly CPI indicator in Australia, it has been slowly inching upwards in the last 3 months. And what's interesting over here is that the Q1 inflation number of 3.6%, if it continues to actually hover at around this 3.6% and 3.5% thereabout, it actually surpassed RBA forecast, because RBA in the previous quarterly monetary policy statement released in February, they actually forecast the inflation rate to actually come down in June, by June, to 3.3%. So given today's figure at 3. This figure of 3.6% is slightly higher than what RBA is expecting inflation trend to be heading towards 2 months from now. So that actually tells us that over here is that inflation, in fact, is slowly starts to tick. Inflation is also getting sticky in Australia as well, not even in US. All right. So that actually explains why the Australia dollar burst up towards 64.90. So that's our resistance yesterday. For those who actually follow our daily dose since the start of Monday, we do flip to a bullish bias on the Australia dollar in short term to expect that potential counter trend rebound, which indeed has taken shape. Okay, so other key data to watch out for over here will be Apple. So if you look at Apple over here, why Apple is the second biggest component weightage stock in Nasdaq 100 and SPX 500. Apple sales in China continue to be lackluster. So it was reported that the iPhone sales dived by 19% in Q1. So this is the worst quarterly performance since 2020. All right. And what's interesting over here is that despite the fact that Apple current product suite is not doing so well in China, on the same day, which yesterday, Apple actually released saying that they're going to hold a new launch product event on May the 7th with new iPads being expected. So, all right, so something to look out for, given the fact that let's see what Apple has on its back of new products, so to hopefully to able to negate the very weak sales figure that is taking shape in its key market, one of this key market, which is in China. All right. So with that, that pretty much sum up the events, the news flow, and as well as the longer term intermarket correlation based on the macro, we call it a basis of what has taken shape in the markets right now. So with that, let us now jump straight into the short term technical outlook of the various cross asset classes. So let's start with the FX market first. All right. So over here, the FX market, let us kickstart with the euro dollar. So let me expand my screen so that you guys could see. Okay, I think it's slightly hang right now, if you don't mind. Okay, give me a minute. I think it's a bit jerky. Okay, hopefully that, yeah, it's back to normal again. Okay, euro dollar. So euro dollar going to actually pierce much higher. So what we could see over here is more like a counter trend rebound scenario. Still holding below the 10725 short-term pivotal resistance that we highlighted at the start of this week, and also correspond to the 20-day moving average as well, I think, as a resistance. And what we could see so far is that the bounce has already traveled close to 38% Fibo retracement. Okay, 38% Fibo retracement. So with that, we'll be flipping to a okay, we will still maintain that short-term bearish bias at 1.0725. First support level to watch for today will be at 1.0640, which is the minor ascending trend line support that I drew from the low of last Wednesday over here, or last Thursday, I would say. 1.0640, pardon me. Only a break below 1.0640 exposes the minor swing low of last Wednesday at 1.060 level, right? Only an hourly close above 1.0725 will invalidate this bearish tone to see a continuation of this minor counter trend rebound scenario to expose the next resistance at 1.0780, which is the 61.8 Fibo retracement. Above it sees 1.0820, which is the 76.4 Fibo retracement, as well as the 200-day and 50-day moving average, acting as a similar resistance level as well at 1.0820. The sterling dollar. So the sterling dollar continued to squeeze up yesterday and hit the resistance level, coming at 1.2480 level over here, and the RSI is now at the overbought region already. All right. So with that, I don't want to use 1.2480 as my short-term pivotal resistance level. I will use this much more key resistance level here at 1.2520. What's 1.2520? If you go to the 4-hour chart, okay, it's a pretty much key former medium-term range support level that was in place since 8th of December and 6th of February, where it actually broke down recently on the 12th of April before that triggered this last 4 weeks of down move. All right, so I'll be using this 1.2520 as my key short-term pivotal resistance for today. If this level is not surpassed to the upside, potentially we may see a bit of retracement on the sterling dollar. First support level to watch will be at 1.2390. A break below 1.2390 exposes this Monday minor swing low area, which is also confers with a psychological level at 1.23 figure. Right, only hourly close below above 1.2520 will negate this bearish tone on the short term to see the continuation of this minor counter trend rebound to actually revert back upwards. Next resistance level to watch will be at 1.2570. Above it exposes 1.2640, which confluence with the 50-day moving average, acting as a resistance, and also the the minor descending trend line that I drew from the high of 8th of March, also acting as a resistance at 1.2640. All right. Asia Pacific currency, the Aussie dollar. So Aussie dollar on Monday, we do have that bullish bias. So price action pierced up and hit the 64.90 resistance. And right now, it's actually coming close to the 50-day and the 200-day moving average, and as well as this this minor swing high area of 12th of April at 65.45, and also taking into account of the Fibo retracement of the push down from 9th of April all the way to last Friday swing low is the golden ratio at 61.8%, also at 65.45 resistance. So with that, and also the RSI also has hit a rather high overbought level at 85, okay, 85 at today. So with that, given the fact that RSI overbought coming close to a key short-term resistance at 65.45, so potentially there could be at least a retracement after these 3 days of strong push up, all right, strong rebound. Okay, so with that, using 65.45 as my short-term pivotal resistance for today. First support level to watch for that retracement will be at 64.60. A break below 64.60 exposes this Monday's low at 64.25, okay, which is the congestion area here as well of last Friday to Monday. Okay, this congestion area pretty much key. Okay, so only a clearance above 65.90, 64.45, pardon me, will invalidate this short-term bearish bias to see the continuation of that very steep counter trend rebound scenario to extend. Next resistance to watch will be at 65.90. A break above 65.90 exposes the 9th of April swing high area at 66.40. All right, 66.40. Okay, so that's for the Australia dollar. Dollar yen. So dollar yen continues to trade within a very tight range, but still in a very uptrend in a short term uptrend phase since the low of 5th of April, it's going to oscillate within this minor ascending channel that I drew. So yesterday we do have a short first support level at 154, around 154.50. So 154.50 price action managed to dip and it managed to bounce again, but still refusing to crack above the 155.10 level resistance level, which is close to the 155 psychological level as well. So no change. I don't put it so tight at 154.50 as my short-term pivotal support level. Still using 153.90, which was last Friday, kind of a minor steep slide before it rebounded. So this one and also correspond to the previous intraday movement sell-off as well on last Tuesday, which is at 153.90. So no change. Still using 153.90 as my short-term pivotal support level. As long as any price intraday slide didn't surpass 153.90, still maintain that short-term bullish bias on the dollar yen. First resistance to watch will be at 155.10, then thereafter followed by 155.70. Right, only an hourly close below 153.90 will negate this bullish tone to see the a much more pronounced slide to expose the next support area at 153.30, followed by 152.70, which is correspond close to the upward sloping 20-day moving average, and as well the minor swing low of 11th of April and 12th of April as well. Okay, so since we are talking, we are here at the FX market spot gold. So spot gold continue to shape that strong bounce up from that 2,300 short-term pivotal resisted support level that we highlight. So earlier on, we expect that mean reversion decline to take shape. So the mean reversion decline take shape has hit the support level at 2,300 and it shaped that bounce. All right, so reintegrate back above the 20-day moving average. So still no change for sure. 2,300 will be indeed our short-term pivotal support level to maintain this next leg of bullish up move for gold, spot gold XAU/USD, and first resistance to watch over here will be at 2,365. No change as of yesterday. Above a break above this level, potentially re-expose or retest the swing high area of 12th of April and 19th of April, which confluence at 2,420. All right, only hourly close below 2,300 will invalidate the short-term bullish bias recovery scenario to expose the next support area or support levels at 2,265, 2,235 for spot gold. All right, now major indices. Let us start with the Hong Kong 33 with the Hang Seng Index. So the Hong Kong Index yesterday we were neutral, so it actually hit the upper limit of the neutrality range, which is close at 17,000 level and going to pierce up right now as we are speaking. And right now it's coming close to the top of the range again. The range resistance that is in place since 13th of March didn't surpass on 9th of April before shipping back down to the bottom of the range support and bouncing back up. So now it seems that we are at the top of the range again, and with the RSI at the hourly RSI at a rather high overbought level of 81, we will actually flip to a bearish bias, at least in the short term, at the near the key range resistance of 17,230. We also confluence very closely to the downward sloping 200-day moving average as well for a potential at least a minor setback scenario to take shape within the range configuration All right, first support level to watch will be at 16,785, a break below 16,785. So that it was actually yesterday's US session low where it tested and it bounced. Then break below 16,785, pardon me, will expose 16,600, which is the former minor swing high of this Monday. Also confluence with the 20-day moving average, also acting as a similar support level at 16,600 as well. However, an hourly close above 17,230 will actually see a potential squeeze up to test the medium-term pivotal resistance area at 17,600. So 17,600 will be this congestion area over here of 23rd of November and 24th of November. Okay, so that's for the Hong Kong 33 or the Hang Seng Index. On the Japan 225, Japan 225 yesterday managed to squeeze up higher above our short-term pivotal resistance at 38,000. This level here, 38,200, and right now is coming close to this former dotted line here. So this line here is actually a former major. Okay, so if you look at this line, go to the daily chart. Okay, so this is a former breakout line, bullish acceleration. Okay, that I drew from the low of 6 January 2023. The price accelerate up. After accelerating up, it can't maintain the momentum and it peels back down. And this line here turns into a pullback resistance as well. Okay, and if you do the Fibo retracement, okay, of this entire push down from the high of 21st or 22nd of March, it confluenced with the 38%. And if you take into account of the most recent decline, it take of 12th of April high, it confluenced with the golden ratio of 61.8 as well. Okay, so with that, right, this seems to me a very key resistance level to watch. But given the fact that it's kind of a mixed element right now, there's so we will be much more having a neutral bias instead of a, so neutral between this 38,800 level and the lower limit is at the 37,820. Only a break below 37,820 will kind of lead more credence to the revival of a short-term bearish tone for the Japan 225. All right, so neutral for today between 38,800 and 37,820. Then German 30. So German 30, yesterday we flipped to a bullish bias for that potential counter trend rally. So that potential counter trend rally has taken shape and hit the resistance level at 18,210, 18,310, which is right now. And if you look at the RSI, also now coming very close, hitting a relatively high overbought level at 79 yesterday. And if you look at the Fibo retracement of that entire the current push down from the all-time high of 2nd of April all the way down to last Friday swing low, is now coming close to the 76.4% Fibo retracement, which is also confluence with the minor swing high of 8th of April. So with that, I'll be using 18,400 as my short-term pivotal resistance for today, looking potentially for at least a bearish retracement of these 2 days of steep up move on the German 30 index. So first support level to watch will be at 18,000 level. 18,000 level, all right, 18,000. A break below 18,000 exposes 17,840, which also confluence with the 50-day moving average, I think, as a resistance as well. However, a breakout above 18,400 will see the continuation of this very strong bounce to expose the next resistance level at 18,490, followed by the all-time high area at 18,620. So that's for the German 30. US Wall Street Index. So US Wall Street Index is now resting at the short-term pivotal resistance that we highlighted yesterday, also close to the 20-day moving average, acting as a resistance area, very similar to as well at 38,590. So still no change, using 38,590 as my short-term pivotal resistance level. Potentially looking for at least a bearish retracement of these 2 days of strong push up First support level to watch for sure will be this very clear minor congestion area, now turns into a pullback support level. 38,020 below 38,020 exposes 37,700. Only hourly close above 38,590 will invalidate this short-term bearish bias to see the continuation of this strong rebound scenario to take shape again. Next resistance level to watch will be at 38,930, which is the minor swing high of 8th of April and 10th of April. And if you do the Fibo retracement of the current all-time high of 1st of April all the way down to last Friday swing low, it also confirms closely with the 61.8% Fibo retracement as well at 38,930. Then what we have over here is the Nasdaq 100. So Nasdaq 100 going to actually shape that squeeze up as well, very similar. And right now it's coming very close to the Fibo retracement of that 61.8% Fibo retracement. Okay, taking into account of the push down from 12th of April all the way up to last Friday. 61.8% Fibo retracement is at 17,810 level. So 17,810 level also confluence with the minor swing high area of 17th of April that was being kind of congested before that last 3 days of sell-off take shape. All right. So with that, using 17,810 as my short-term pivotal resistance for today, do expect potentially a kind of a minor bearish retracement after these 2 days of steep move. First support level to watch will be at 17,390, followed by 17,290, which is the very clear congestion area over here. Okay. However, an hourly close above 17,810 will invalidate the short-term bearish, we call it retracement scenario, to see the continuation of that this positive squeeze up. Next resistance to watch will be at 17,965, which is the 50-day moving average, I think as a resistance, followed by 18,190, which confluence with the minor swing high of 15th of April, and as well closely to this descending trend line resistance that I drew from the high of the all-time high of 21st of March. Okay, lastly will be WTI crude oil price. All right, so the West Texas crude oil price over here continue to bounce above the 80 short-term support level that we highlighted earlier. Okay, let me share with you. Okay, so if you look at the daily time frame, okay, so daily time frame is start to show a very strong positive follow-through candle yesterday after that bullish dragonfly doji that was spotted on this Monday, retesting the 50-day moving average. All right, so you need to ask that this ongoing medium-term uptrend scenario that I draw from the low of December this year continue to evolve within this medium-term ascending channel as well. So the next medium-term resistance to watch will be at 90.70, but that's for a longer-term perspective, multi-week perspective, given this daily chart. All right, now from a short-term perspective, right, the levels to watch, for sure 80.80 will be the short-term pivotal support level. Okay, so first support level for any kind of a potential pullback will be this level over here, okay, which is at 83.24. Okay, former minor swing high of 23rd of April now turns into a pullback support, but I don't put it so tight at this level here, so I'll still use 80.80. So 80.80 short-term pivotal support level. First resistance 84.40, above it exposes the minor swing high area of 16th of April and 19th of April at 86.35. All right, so that's for the West Texas oil. Only hourly close below 80.80 will negate this bullish tone to see another round of choppy decline to expose the medium-term pivotal support area at 80.80 slash 78.80, pardon me, slash 78.40. All right, so that's pretty much sum up for today's daily dose of short-term technical outlook. So before we go, let's take a look at the economic calendar. What are the key data to look out for? So for today, right, we do have Germany consumer business climate, which is kind of a business consumer confidence index, out later at 4 p.m. Singapore time. All right, then thereafter in the US session, we do have even this crude oil inventory that could impact WTI prices. So crude oil inventory weekly change for the week of April 19, ended April 19, will be at 10:30 p.m. Singapore time. Okay, then thereafter pretty much unclear. There's nothing much, and most important, at the end of the US session, we do have the earnings release of the one of the Magnificent Seven cohort, which is metal. Okay, where is it? This Tuesday. Yeah, metal. Yeah, metal will release their earnings, Q1 earnings at the end of the US session today. That means way early Singapore time. Markets are expecting a very high number, earnings per share of 4.32, almost doubled, almost seen the same quarter a year ago at 2.2 EPS. All right, something to look out for, given that a very strong, rosy, optimistic expectation has already been priced in ahead of the release of metal earnings. Okay, that's going to be at the end, at the close, after the close of the US session today. Okay, so with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.